Let's bring in Mike Wilson, Morgan Stanley's chief U.S. strategist and chief investment officer, for his thoughts on what is to come. Mike, it's always great to get your thoughts. You made that call prior to there being any sort of war on continental Europe. And so do you think, I mean, you haven't put out a note yet, but do you think that the risk is really to the downside of even your target?
Yeah, thanks for having me, Melissa. Yeah, I mean, look, I think, as you said, I mean, we came into this year not that optimistic because obviously the Fed was going to have to tighten due to the inflationary spike. And of course, growth is slowing, as you described. And, you know, the Russia's invasion of Ukraine only makes those two conditions worse, right? Because you now have more inflation, so they can't really back off. I mean, I would say, you know, one thing about geopolitical events like this, I mean, normally, you know, you want to rush in and maybe buy these events, but at this time, I think it's different because central banks are kind of hamstrung, right? Normally they would flood the system with liquidity. They can't do that this time. And it's also going to have a negative impact on growth. So yeah, I think it's a much easier kind of thing to say now that we're going to trade sub 4,000. It was more difficult back in January to make that call, but I think now it's kind of a fait accompli. And look, you all are saying it on the show. I mean, you're market veterans. You see what's going on under the surface, whether it's high yield, the breadth of the market, you know, what the leadership has been. It's been very defensive. So the market's screaming at us, and we're not complete yet. We're, you know, Dan said it right. The market's priced incorrectly at 19 times. You know, we've had an 18 multiple. That was why we were more bearish than most. And I would suggest we probably overshoot that sometime this spring.
What is the risk, the biggest risk to the markets right now, Mike? What do you think is going to be the number one driver to the downside to your target?
Well, clearly, I mean, this, you know, situation in Russia, Ukraine is front and center. I mean, nobody knows which way this is going to go. We're all hoping that it calms down. I have no insight whether that's going to be the case. I'm praying for that. So hopefully that fades. And then I think the market will focus on what it always focuses on, which is earnings in the U.S., right? Because look, the U.S. market is somewhat distanced from this situation geographically and financially. There's going to be ramifications indirectly. However, you know, I think earnings are going to slow anyways. I mean, that's been our call. So whether this situation calms down or not, we still have to face, I think, negative earnings revisions across a lot of sectors, particularly consumer, maybe some of the financial system now, given what's going on in Europe, and of course technology, which there's just going to be payback in demand. That's starting to play out. It's been playing out. It was playing out before this invasion.
You know, in your notes, Mike, you put boring is beautiful, and there's nothing more boring than railroads, although I happen to love them, by the way. I was a kid. I used to love the model railroad. That's neither here nor there. You look at some of these names. I mean, Union Pacific, last I look, is making an all-time high. Reasonable valuation, and companies that are far more efficient energy-wise than some of these trucking names. I'm not looking to play stock market here, but does that make sense, the railroads in this environment?
Yeah, absolutely. I mean, and look, we call this year the year of the stock picker, and I think that's what you got to do. You got to find businesses you think are somewhat protected from the issues that we're facing, who have either pricing power or, you know, they don't have issues that other companies are facing, and that may be one example. You know, I don't have any railroad names off the top of my head that I love, but structurally that makes sense to me. And then look, this environment is changing, right? I mean, obviously defense stocks, maybe security stocks. I think oil services, which is going to maybe enter a structural bullish period because we underinvested. I mean, there are things that are happening from this unfortunate incident, which is going to help some companies. That's what you got to do. You got to bob and weave here a little bit and find the new opportunities and not rest back. It's going to be the same old type of market, because it's not.
Mike, great to get your thoughts. Thank you so much.
Thanks for having me.
No Wall Street strategist has been more cautious over the past 6 months than our next guest, Mike Wilson, the chief U.S. equity strategist at Morgan Stanley. He joins us now, and he's right here at Post 9. Welcome to Overtime.
Thanks for having me. It's great to be back.
I didn't misrepresent that. I mean, you've been cautious for at least the last 6 months. Are you anything but that today? Are you growing more optimistic?
Well, look, I mean, the good news is prices adjusted, right? I mean, that was always our big concern, has been valuation. So that's good, right? Prices have come down, and that's mostly the Fed tightening, and that's happened, okay? But now, you know, we get into the slowdown part, and that was the second part of our concern. And unfortunately, this, you know, Russian invasion of Ukraine just makes that, you know, more tricky. So, yeah, I think, you know, generally our targets were 4,400 for year end. Bear case was 3,900. I would say we're probably somewhere between that now, you know, given the events of the last couple of weeks.
You think multiples still have to come in a bit, largely because earnings are going to slow down? And look, we've already seen negative revisions pick up.
Sure, absolutely. So, like I said, we've discounted some of that. But also the Fed has to go harder now, potentially, in the face of slowing growth. That was always our concern. So, markets don't go to fair value. They overshoot, right? We overshot to the upside, we'll overshoot to the downside. So this week's note, we just talked about that dynamic. Could it be 16 times as opposed to 18 times in the short term? Sure, it could. We're not that precise.
There's caution on stocks, and then there's just downright negativity. You said today in a note, bonds are starting to look more attractive versus stocks. I mean, you had to go there?
It is a little, that's a little extreme. But look, Scott, bonds have corrected just as much as stocks. Normally, when you get a stock market correction, right, bonds are a safe haven. But rates have been going up and spreads have been widening. So we do think it's interesting. For the first time, really in a couple of years, I can look at long duration treasuries and say, look, this may not be a bad bet if you're worried about growth. Like if you're like us and you're worried about growth, then maybe long duration bonds make sense in this environment. If you're not worried about growth, then it's not going to work.
Well, what if you're overdoing it on the worries? Marko Kolanovic, right? We cite his research all the time, says too much negativity is priced in, urges people today to add risk to equity. Scott Minerd, Guggenheim, Scott Minerd, one of the biggest names who ever come on this network. I think that as the Fed starts to tighten, stocks will start to rebound. He thinks that rates are topping out here. He'd be putting some money to work in beaten down areas.
Yeah, we would agree. We agree that rates might be topping here in the back end. I just don't think you're going to
for the wrong reason, though.
Right, you're not going to get the elixir on the multiple because the market now is worried about growth. Look, I think if Russia had not invaded Ukraine, we might be in the same position. We'd probably be more interested in trying to bottom fish here. But this event has really structurally changed the outlook for this year. Even if there's a resolution, let's say there's a ceasefire, it's not like you can put this all back into the bottle now. It's going to be difficult to put the inflation back in the bottle. The Fed's going to have to go maybe harder. And the growth risk, which is really the concern now, gets worse.
But you have a key unknown removed from the picture, and then we can get back to what we know, and that's the Fed is the chief participant in the ball game that we're all trying to watch and figure out how to play.
I think that's right. But once again, it gets back to growth. So we've always been a little bit more negative on growth this year on earnings, right? No recession. We're not talking about recession, Scott. We're talking about earnings, which is a margin issue potentially. The costs start to flow through, and that has to play through now. So, I don't think this is going to be a situation that lasts for the entire year, but definitely through the second quarter.
I appreciate you coming down here. It's good to see you face to face. We'll have you back on Overtime, and I'll see you on the half. That's Mike Wilson from Morgan Stanley.